The Nasdaq is down, the SPY is down, and my portfolio is down. Now, in this video, I'm gonna discuss the current market conditions, and I wanna go over what I'm planning to do about it and how I'm planning to go forward with this market as we continue in the coming weeks. Now, welcome back to Growing Quality. My name is Adrian, and let's just dive straight into it. Now, as at the beginning of this video, you saw the charts of the Nasdaq and the S&P 500 that were pivoting downwards. In my opinion, this is because we have a Fed that is starting to become more hawkish. Now, only yesterday we had two Fed officials that were speaking. This was the Fed President Williams and the Atlanta Fed President Bostic. And what they were saying is that Fed President Williams sees no urgency to cut interest rates, and economic data will determine the timing of rate cuts. So what did the Atlanta Fed President Bostic say? Inflation is too high, and he doesn't think it will be appropriate to lower borrowing costs until the end of the year. Now, just as a reminder, when we started 2024, markets expected the Fed to cut rates about 6 or 7 times. Now we are talking about maybe one at the end of the year. And the question should be, why is that? Well, it's actually quite simple. Because the inflation reports, jobless reports, job openings, they have been coming in way too hot. So what we are currently seeing in the economy is that inflation keeps on coming in hot. And with the Fed having the dual mandate they have continuously signaled, they have no reason to cut interest rates. Not at all. So the expectations that are coming down for interest rate cuts this year, or the amount of interest cuts, that's only logical. First of all, let's see how this affects stocks, because I have an interesting take for one of the stocks I own, and that is Monday. Now, what you should look at here is the dates, because this is from April 12th and this is from April 18th. So that's 6 days apart, right? Now, these are both articles from Zacks, and they have their own ranking system for stocks, right? They rank them from 1 strong buy to 5 strong sell. Now, what I want you to see here is that the articles are almost exactly the same. However, suddenly on April 12th, Monday still posts a ranking of 1, a strong buy. Now, then all kinds of stuff started to happen in the Middle East. Monday.com fell as a result of it. We also had the hot CPI data release of last week. And now all of a sudden, Monday.com is a hold. Now you have to explain to me what has happened in the last 6 days between those articles that a stock is suddenly from a strong buy to a hold. Well, there is no data about the company. According to the articles, there is no change in EPS projections. But the only thing that has happened is that stocks have been falling, and this is what we see everywhere. Because if we go on, here we have Ulta, another stock that has been falling, another stock which has been seeing changing sentiment. Now, Ulta Beauty does have an actual catalyst for falling. And the catalyst is coming from an article which I'm about to show you. But as we can see here, on this day, the stock actually dropped about 12%. That's quite a bit drop. But what's even more significant about it is that it wasn't just a drop. It wasn't on earnings. And the stock has continued to move down afterwards. Okay, so what happened that day? The company participated in an online conference of JP Morgan, I believe it was. And what they said is what's coming back in this article. So let's go through it together. Because, of course, the title is Why Ulta Beauty Shares Are Falling Today. Ulta Beauty shares are falling on Wednesday. The company's executives cautioned about a deceleration in demand across categories in the first quarters. Ulta expects its overall category to grow moderately in the mid-single-digit range, making a shift from previous years of robust expansion. What we've seen so far is a slowdown in the total category across price points and segments. That's a bit earlier and a bit bigger than we thought, CEO David Kimball told JP Morgan analysts during a fireside chat. Okay, so why do I think this is specifically notable? Well, in my opinion, this is one of the examples I'm gonna show as to why the consumer is starting to get a hard time out there. Now, the next example I have of it is Nike. And you can see the stock of Nike, it's been trending down. Now, this is not the longest term chart. It's going back about a year. But as we look down, if we look backwards even further, the stock was even higher. Nike is down significantly from its highs. And what is happening at Nike is fairly easy to explain. And I took some charts from Qualtrim because they visualize it very, very easily. Now, I have both the annual numbers, which are these and these charts. And the top one is revenue, the bottom one is net income. And then I also have it broken down quarterly. Now, why did I do so? Because we have CAGR numbers standing here, and they might be a bit different when we look at it quarterly compared to annually, because the last quarter was not a completely finished full fiscal year. Next fiscal years, they go a bit different. So that might change the picture around a bit. So having said that, what point am I trying to make here? The point I'm trying to make here is that if we look at an all-time revenue chart of Nike, we can clearly see that it's making this motion. It's moving up at a very steady pace. And that's what we want to see. But when we look at this chart of the revenues for Nike, and this is quarterly over the last 10 years, what we can see happening is that it's flattening out and starting to point slightly downwards. Now, if we look at it with the year-over-year growth for Nike, we can see that it was only 0.3% compared to a 10-year annual average of 7%. That's not quite good, but hey, it's only one quarter, right? Okay, you might say so, but then let's look at the net income. Because net income, well, that's also going downwards. We can see that last year you're even down from 2021 levels. And that's not good. When we look at it at a quarterly basis, you can see that here it's been trending down, then it popped back up slightly, and now it's down again. Okay, net income might be due to some difference in accounting. However, if it wasn't as big of a problem, then Nike wouldn't have to start a $2 billion cost-cutting program, which they did. Okay, Nike might be old, different category than Ulta, but it is very much consumer-facing. And I have another consumer-facing company which is reporting some difficulties with their growth. And why I'm taking the next company, even though it's a competitor of Nike, because it's very much known for their strong growth. And that's Lululemon. Now, I'm doing my full analysis of Lululemon as we speak, and I will post that video on Wednesday. But Lululemon is having an incredible drop here after earnings. And from here to down here, the stock has seen about a 30% drop in share price. So what has happened at Lululemon which has caused this to happen? Well, it's quite simple. Growth is slowing. Over the past 10 years, revenues of Lululemon have increased at a above 20% CAGR. For fiscal 25, because they are 1 year ahead in their fiscal year, so in 2024, fiscal 25, They expect growth to be 11 to 12% on a revenue basis. And this includes a 53rd week because their fiscal year ends at the Sunday closest to January 31st. Taking that 53rd week out of the fiscal year, so a normal 52-week fiscal year, they expect growth to be 10 to 11%. Now, this is quite a bit lower than having it compound at over 20%. On top of that, the CEO mentioned during their earnings call, their last earnings call, that they were navigating the difficulties of retail in the US. Now, the CFO quickly pulled him back and called him back by saying, yeah, we don't comment on intra-quarter developments or trends. But he already said it. In the US, Lululemon is having a difficulty with their retail. And they said international as well as Canada was doing fine, but they specifically saw difficulties in the US. However bad it is, it's hard to tell. But they also guided for EPS growth of only 3 to 5%, depending on the low or high end of their EPS guidance. Now, I do have to mention with it that this is also because they continue to invest in SG&A, but still, they are seeing clear slowdowns. Nike is seeing it. You can see it in the numbers of Nike. Ulta is reporting it. And why is that? Well, in my opinion, it's fairly simple, and it's the Federal Reserve. Here we see the 10-year interest rate. And after it peaked right here at 5%, remember Bill Ackman, he was so bearish that he had to go short on the bonds. And when it peaked at 5%, he sent a tweet, we covered, and that day was the exact top. It was, in my opinion, it was an incredible trade. It was magnificent to see. But the point I'm trying to make here is that after it, interest rates came down a bit. This is also where we started seeing stocks rally again. And this has been able to continue up till now because interest rates have been increasing again. And they have been increasing faster. And with the increase of interest rates comes the fear of a recession. Now, this is not something I'm going to signal here or I'm going to say here like, oh, we're going to have a recession. Everything is going bad. It's all so terrible. No, that's not the point I'm trying to make here. I'm just saying what I see and how I see it continuing. And that having said, what's next? What am I going to do about it? Am I just going to continue to DCA 125 euros into the market every week? Am I taking a step back? Am I raising cash? Am I trying to... I'm going to explain to you what I'm going to do next. So let's look at my portfolio and see what moves I'm making. So here we have my Trading 212 account. I think Trading 212 is best compared to Robinhood, but then a European version. Now, why would I use this platform? Well, quite simply because for me, for where I live, this is one of the only platforms that has fractional shares. It's not as common in Europe. And for the intentions of this portfolio, it's actually quite a good platform. So let's first run you through my portfolio because we have Enphase, we have Ferrari, we have Monday, we have Moody's, PayPal, Rivian, and S&P Global. Now, the philosophy of this portfolio is that I DCA 125 euros into it every week. Now, by DCA, I mean I just deposit 125 euros and then it's a continual basis. And what I'm trying to show with it is how much that monthly or weekly amount stacks up over the long term. Now, why do I think that's important? Quite simply, because I think with 500 euros every 4 weeks, that's quite doable. €500, $500. And I want to show how quickly that adds up when you just keep doing it. That having said, this is not my main portfolio. This is my YouTube or social media portfolio because hey, every YouTuber needs to have one. Otherwise, you're not part of the game. So I just follow the rules. I don't make them. Anyways, starting off with Enphase, I think the company has priced in a lot of pain already. I have a full analysis of Enphase on my portfolio or on my YouTube channel. I think it's a very good one, and I also highlight the risks I'm seeing with the company. Now, will I sell Enphase? Will I add to Enphase? Time has to tell. I might be a bit pickier with where I'm buying. I'm down slightly on it, but I do think Enphase will recover during the year. As I also explained in that video, my style for this portfolio is not to just dump a huge amount into Enphase or a relatively huge amount. What I'm doing here is just slowly and surely increasing the position. So you want to catch the entire bottom. It's rounding out a bit at the bottom. You try to pick a bunch of spots at the moment that it's starting to turn around. And therefore, the decision I have to make with Enphase is, do I think the company is worse or better off right now? Do I think the macro environment is deteriorating at such a rate that this company has become uninvestable, or that it's going to do very much worse than my initial thoughts? So then we have Ferrari. And I'm very surprised by Ferrari, actually. I made a video, I think 2 or 3 weeks back, in which I said, okay, maybe I'm not as bullish anymore on the markets as I was. I see some issues growing. I see people looking only one way. I'm getting concerned by the overly greedy markets, which have just been persisting. There's been no pullbacks. Everything's being bought up. And I mentioned I was concerned about it. Now, what I also said is that I thought Ferrari was a bit too highly valued for me to keep adding to it. And basically, Ferrari is holding up almost the best of all my stocks. Well, Ferrari does have that function in my portfolio. It's supposed to be a stable factor, and it's doing that quite good. Better than I thought. So, will I start buying Ferrari? Well, I'm still of the opinion that it's too highly valued. I have a spreadsheet in which I have the PEs of every stock, and I also have the expected EPS numbers for 24 as well as 25. I also have the 25 PE to look at it a bit further. Maybe there are some short-term issues which analysts see going away or fading away. And Ferrari is simply very highly valued. But they also have a very good customer because they sell extremely expensive products with very high margins. And the super rich, we know, they are not as affected by recessions or higher borrowing costs, or they will keep buying Ferraris. And we also know this because Ferrari is supposedly sold out until 2025 or 2026. That's Ferrari. I'm not going to sell that one. Absolutely not. Will I be buying? I'm not sure. Because if we are going to see multiple compression in the overall markets, I think Ferrari should have it as well. And if it happens, I will be aggressive on the name. Okay. So then we get to Monday. And yeah, I know why it's falling, but I don't agree with it. I don't have to agree with it. That's something completely different. It's not my opinion that matters. It's the move that it's making that matters. But it's falling. And why is it falling? Well, very simple. We have the conflict in the Middle East. That's one reason. Because Monday is headquartered in Tel Aviv, Israel. Now, another reason is the interest rates. Because interest rates affect the smaller cap companies the most. Monday is a $9 billion market cap as of now. And that just means that people assume it to be more volatile. Now, Monday has no debt whatsoever. They have about $1 billion in cash, which they can use for buying treasuries. And the only downside I see to Monday is the fact that they have a seed model. So you can license seeds, you can add seeds to your contracts or to your license, and deducting seeds is also quite easy with it. So that's the only issue. If other companies start becoming more disciplined with their spending, that might start to become an issue. Now, will I be buying or selling Monday? When I start buying, I will buy Monday. I don't know if it's done falling. In my opinion, the fall of Monday has not been really justified. But again, it's not up to me, it's up to the markets, and I will just respond to what the markets want. I think it's good buy. It might still be a bit on the high side, but it's a good buy. Then we have Moody's. And Moody's is my stable factor in the portfolio. That's the function of it, that's what it's doing. Just like Ferrari and just like S&P Global. I'm down 2% on the position. Same with S&P Global. Am I planning on buying or selling the company? I added a bit to it. Also with S&P Global, I also added a bit to that position. I view it as one, basically, and they are stable together. Together, they are also now the largest position in my portfolio. And for now, for the next coming 1, 2, 3 weeks, maybe a bit longer, they will stay that way. So yeah, I'm not gonna sell them. That's basically what you could already taken out of it. And then we just go and look at PayPal, because PayPal PayPal has also fallen about 5% in the past week. And will I be selling PayPal? No, absolutely not. What we can see here is that analysts slightly increased their price targets for PayPal. And to me, that seems justified. But it is a trend I'm seeing now and haven't been seeing in the initial move over the past 3 months. Now, PayPal, in my opinion, still represents a good buying opportunity. However, seeing how it performed over the past 3 years, it might be a bit of a tough buy right now. If markets are deteriorating, we will just have to see. It's a case where I just see what's going to happen with it and I respond to it. And now we come to the last one, and that's Rivian. And for Rivian, I'm not quite so sure what I'm going to do with it. Rivian has been kind of a victim of the overall EV market, in my opinion. However, as I was going through the numbers again, I wasn't all too sure, and I may have made a mistake in terms of their path to profitability, may have overestimated their capabilities or underestimated the time it would take. For Rivian, I'm not quite too sure what I'm gonna do with it. It's gonna depend on the upcoming earnings call. Now, what will I do if I sell Rivian, where I'm gonna put that money into? There are a few companies I'm looking at. First, let me explain what I'm gonna do with the cash I have in my portfolio. Because as of now, I'm about 20% cash, and I plan on adding to that number. Gonna keep putting my 125 euros into the portfolio, and I'm gonna see how I deploy that capital. Now, one thing I do know is I'm not gonna deploy all of it, because as I just mentioned, I'm gonna stack my cash position, because I don't think that markets will recover in the coming week. I think we may go through a couple of weeks of pain, and after those couple of weeks, we will just come out of it, but it's going to give me some, or maybe quite a bit, of buying opportunities. So what are the buying opportunities I'm looking at? Let me show you. So we just talked about Lululemon, how they saw revenue slowing down, or revenue growth slowing down, but so has the stock been coming down. Now, do I think it's fairly valued now? Well, maybe not quite yet. The company is still trading at a 28 PE, while they just said that revenues are slowing down, well, quite drastically. Where do I think Lulu might start becoming interesting? If it drops another maybe 10%, going down to $320, $300 per share, that's where I think this will be interesting, and that's where I will be aggressively picking up those shares. Now, another stock I'm looking at is MSCI, because MSCI has been dropping quite a bit. And yesterday on my X account, I posted about MSCI being very, very cheap. So how cheap is MSCI trading? Well, this is a weekly chart, and you don't have to be an expert in charts or believe in charts just to see when the daily candles start coming really close to the 200 simple moving average. That's in the past, 2 years been a great opportunity to buy the stock. Even if we go down further backwards, it never really gets there. Now, there are some reasons for it. And one of the reasons is that it has been taking out a lot of debt in the past to do stock buybacks, and it can't do so now, or that period has ended. However, it's an incredibly reliable company and stock, which will always hit their earnings. So seeing this company trade at a 34 PE might sound high. It is high, but the company is delivering extremely steady revenue growth, EPS growth. It's having an incredibly steady business model, and it's always traded really richly. Having a 34 PE is actually on the low side for this company. So yeah, that's where I'm trying to deploy my capital, or where I'm looking to deploy my capital. I want to thank you for watching my video, and I hope to see you in the next one.